Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com. Welcome to today's morning call. It is Wednesday. So far, 2016 has been a sea of red. I don't know if most people are surprised, but when reality hits, I guess it always does hurt in some way, even if you try and be prepared for it. In my 2016 report, I talked about the risks to the downside outweighing the upside potential for the first time since I've been writing that report since 2011. Lining up the technical picture that we've seen, a lot of people were upset about 2015, basically saying, the S&P was only down 1%, but leadership was so narrow. You had many stocks making new lows versus new highs. There just a lot of bearish signals, besides most sectors being below all the key moving averages. And then we started off the year with that huge gap and go to the downside, creating that big hole that, didn't get filled. Yesterday maybe gave people a small, false sense of security, including me, because I'm a tiny bit long, which I'm a little upset about, because I've been pretty bearish. But anyway, people are like, why are the futures down, 35 handles today? You could probably look at 5 different reasons why, if you look at all the different headlines. You have one, a new headline, North Korea with a hydrogen bomb. That's definitely something that's going to be talked about all day, whether, it's saber rattling or whatever, that's there. You have, Asia, still weakening. You have Europe not finding a bid. You had Fed Fisher yesterday really telling it like it is. Fed Fisher basically said, the Fed did the QE, to basically front run a rally, which has been fierce and strong for 6.5 years, okay, to try and create the wealth effect. And now their foot's off the pedal because they've run out of bullets, so the market has changed. So as a trader, including myself, you have to pretty much take that rule book of yours that you've had for the past 5-6 years and maybe throw it out the door, because that bid underlying stocks might be gone and things might have changed. Not saying you can't play rallies when oscillators, are minus 40 to minus 60, but at this point, these rallies might be a little less, and you have to be that much more careful. And the last thing you need to do is just do a cost average game, because one of those cost average games could put you out of business. At this point, I don't mean to get all bared up when we are getting close to some support levels, but all I'm saying is, guys, this year could be different. Let's all try and change it a little bit, and let's just get right to the chart of the SPX right now. You look here at the chart, you will see actually this is the spiders. I'll show it to you because it's easier to see the hole that I was talking about. So here's where we ended the year. Here is your series of lower highs, and basically this closed right below all the moving averages, giving some clues to, be out of the way for the start of the new year, or be light. And even being light could definitely have hurt. You go across methodically, and this was a spot that did hold, okay, to start the year, making this chart look somewhat constructive. Every time we've tested support, it's basically held. And now at this point, the spiders are opening below this pivot. This pivot right here is 198.59. Write that down. Okay, the question is today, will it, which it's already below, reclaim this and rally back up, or stay below and really trigger some stops and get the market down to the chart that I put on Twitter on Monday, outlining a more compelling support area closer to this 195 to 196.30 spot. Okay, so the trick is, as a trader, I guess, sometimes you look for the cute trade, sometimes you look for a compelling trade, and for me, I've tried to be patient, waiting for better prices. But yesterday, like a lot of the traders, maybe you had a little false sense of security, got a little long, so now you have to figure out what's next. So for me, that 198.60 pivot, I'll get out of my small area of longs, and then I'll figure out what spot is next, and then go from there. And many sectors are all, I don't think there's much to hang your hat on. I guess we could look at the Qs to see what type of damage could continue here. I talked about this major hole in the Qs also below all the moving averages, which is a blaring signal for potential weakness to come if it can't get filled. And yesterday it was actually even weaker than most other sectors. And now today, it seems as if the Qs will be opening below Monday's low. Okay, you have a lot of weakness out there in Apple and other names, which I'll get to. So the question is, to come into this year, would the Qs continue to provide some leadership? And at this point, it hasn't. Now the question is, will it play downside catch-up? So, write down this spot for the Qs. This spot for the Qs is 108.12. So write that down, 108.12. If it stays below that, you have a small spot down here, which is a little bit closer to 106. And then you also have this gap down here closer to 104. So at this point, same kind of situation. You have a left shoulder, a head, a right shoulder, and now you're below all moving averages. And we might be below the 200-day for the first time, in a while. Which again, you don't want to be long when you break the 8 and 21-day here, for at least for swings, which it got below to end 2015, let alone in it below the 200-day. Why do I say that? Because institutions should support the 200-day. Sometimes you get below it for 1 or 2 days, and then it pops back above, and it's a fake out. But remember the oil sector, remember oil, remember a few sectors out there, even the transports. Once they get below the 200-day and stay below it, the trend has significantly changed. If you look here at the XLE, if I show you when this sector traded below the 200-day, I'm not saying that this is going to be it for the Qs, but look way back here. You had the Qs, the XLE break below the 200-day, and then it's been in a downtrend since. And I'm not saying 2016 is going to be a major downtrend, but I think there's definitely some significant signs that it could be. So you got to be freaking careful. Here is that head and shoulders top on the XLE, okay? And since then, you stay tactical, meaning play oversold crazy bounces, but you just don't sit, because if you just sat in the energy sector, you got fully annihilated. Now for today, I'm long small XLE also, because I kind of thought, hey, look at USO weakness yesterday. It's getting a little bit sideways, looks decent. So I will probably be stopped out of my XLE, a small amount today. I will first look at this spot, which is 59.30, which we're probably a little bit below, and then the key will be the 52-week low of 58.21. Okay. So again, if you happen to be in a little bit from yesterday, I see why. I think a lot of us were hoping we're a little bit more of a push up to reshort or get out of the way versus just getting slammed overnight the way we have been. But that's going to show you that that's the type of market we could be in, where if you're looking for something cute overnight, you're better off looking for that, more intraday, versus overnight, because overnight could be scary based on what's going on. So maybe, try and be a little bit more flat unless you're shorting rallies and you're staying with that, and you can handle some pain here and there, et cetera, et cetera. But the XLE itself, see what happens today and see what happens with oil. Oil's at 11-year lows this morning. See if the inventories, it bounces off it or not. The Russell will probably be the first sector to actually test the 2016 lows. 2016 lows in the IWM is all the way down here. Okay, the IWM, you look right there, 107-ish. 107-ish, is right there. And, anytime the Russell leads to the downside, shows you that there's a lack of growth, and some people think that means it could be a recession coming, which, who knows, maybe it could be. But this is your pivot spot there. It's probably going to, open below it, and now you have this, whole trapped level. Here was your first move down, a little bear flag continuation, and now this is going to be a key spot in the Russell, which is right around 107. So watch this 107 right here. Again, look how far below all the moving averages has been. If you even go a little bit further to show when it broke below the 200-day, when it comes in here, really, besides these two little fake out spots, it's been below the 200-day since August. So it's almost been in a bear market, with just small little trades, which again, not a healthy sign. Yesterday, at least, what gave some signals not to be so long was that the banks were really weak. Goldman Sachs was $3, and everything else was trying to rally, and it was still heavy. So the banks haven't been somewhere to hang your hat. And this Goldman Sachs head and shoulders top pattern that everyone keeps talking about is getting a lot more visible. And I guess things need to break their neckline, but this is pretty damn visible. And this too below the 200-day, below all the moving averages. So I guess we'll see. What does this mean? What is this telling us? So you don't want to be blind to these type of things just because they haven't worked over the past 6 years, because we've been in a blaring bull market. So we'll see what happens right here, but this is some big support to watch in the Goldman Sachs. And I talked about in my 2016 report that I think the first move in Apple is down to 92, and some of you guys have been making good money short. If that's the case, great. That also has been very weak that intensified to the downside when it broke this last little ascending channel. This last little ascending channel was right here once it got below the 200-day, and that 200-day in Apple was literally 115-ish. And I remember being long myself before back surgery on this day. And you could try things, but the last thing you ever want to do is get stubborn. Losses happen in this business. Bigger losses fry you. I remember on this day, on that jobs report day, I was thinking Apple was back, right? Held the trend line, big day, engulfed this entire situation. So I got a little long, but I did not get stubborn, and I got out right here from the swing trade. Broke the ascending channel, broke below the moving average, that's 115. You could always make adjustments. Okay, and now you look where it is. It's been friggin' annihilated. And yesterday gave you some more clues to get out of the way. Yesterday, the market wasn't that weak, and look what happened to Apple yesterday. Apple engulfed that entire move the prior day. Okay, that's what happened. Still below all the moving averages. The next real support here doesn't come into play until 92-ish. Okay, and some are saying that the head and shoulders pattern, they're saying it just triggered. I kind of thought that the head and shoulders pattern triggered somewhere really closer to here. Some guys are thinking that the head and shoulders pattern triggered right there, and if that's the case, you could see a heck of a lot lower just besides that, and you know what that'll mean for tech. So just be careful. If you're going to play it because of intraday relative strength, make sure you don't stay too long. We were talking about the first day of the year. It showed strength. Oh, isn't that cute? Apple's been so broken, and it's going to show strength the first day, and then yesterday, again, the true color showed itself. And at this point, truly, left shoulder, head, right shoulder below every single moving average out there. Okay, so at this point, this is, I guess, a spot, and then really, no interest of really being super duper long until something closer to that spot, and that's the flash crash lows. So think about if you would have got out here when this channel broke up here. Okay, so lots of ways, and look at that breakaway gap. I talk about breakaway gaps and what they could mean for stocks and sectors. And when they don't get filled, and look at this breakaway gap to the downside that never got filled. Okay, so that's why I keep showing this, not saying it might not get filled, but here's a pretty damn big breakaway gap to the downside to start the year below the moving averages, and now we're probably going to be all the way down here. And if you go to the more weekly chart, you can definitely see a rounding top, which was the bearish thesis. Rounding top with lots of stocks getting crushed below, and look how far this has come. Okay, you could draw this major trend here, and in relatively speaking, this hasn't even gotten to here yet, and that's where it came from. 2012, and you go back to when this rally really started back in 2009, and everyone's hating the friggin' stock market. Everyone's hating the stock market here. Look where it came from. I wonder what's going to happen if it goes to here or even breaks this and retests that double top, which I'm not saying is going to happen either. I'm just putting things out there that could happen. You go more long term here. Remember that I said the other day on Twitter, I'm like, I wish we were back in 2013 because this looked awesome here. Take out the double top, road to 1700 or above, and now if you look where we are, we're still right here. So, we've seen things change. Look what happened when it changed here and stayed below all the moving averages. Here was your double top, and then look at the size of this move. We're right there. Anything could happen. Make sure as a trader you realize that, because rule books change. So now let's go back more to today again. High beta tech started selling in the last day of 2015, and it's been weaker. Let's go to Amazon. Amazon itself, actually, you look here where it is. Look at the size of this move. So just don't be careful. Be careful of just friggin' buying dips, because that's worked for so long. Also, let's get back more into where we're at and what we could do potentially today. Okay, Amazon did a breakout failure to start the year. Okay, and basically that gave you a little short-term agenda or short-term signal not to sit in it. I don't know why some people have, but that was right there. And now it broke below the 50-day, the first time below the 50-day from here, another change, so hopefully you're not sitting there. And then now, we're on key support here where it didn't rally off of it all. Now it's opening lower. So for today, if you were short Amazon, maybe into this spot, you look to cover, and in this spot, we'll look to see if there's some kind of buyable bounce. Okay, that doesn't happen until this area, which was the gap and the next moving average. So this, this actually right here is a little closer to 590 to 600. So again, a big air pocket here, so don't just start buying, buying, buying. And if you do think it's going to stop before then, maybe like something like this right here, make sure it's a level versus a level. If it breaks that level, get out of Dodge. You do not want to blow up in environments like this. Google, same thing, high beta tech. Breakout failure here in Google was a great 2-day trade for some, and then turned into a disaster for people that didn't see this breakout failure. And now it's hovering on some key support. So chances are, if you look back here, it seems as if Google will probably test this area. I don't know if it's today, but at some point. Okay, and I guess your next point of reference for Google would be this tail, the bottom here at 736, and then really this low here at 717. And then the pivot from earlier in the week was right here to see if it stays below, which is 747. So 747, 717, and then into this area is really where it's compelling. And if we're down here, you better believe there's some people in pain. Facebook is something that I've been gravitating towards because it's just easier to get involved with. There's more volume. It's not as thin and wide, etc. It had a little perkiness yesterday, but it's going to be under pressure also. So if you look here at Facebook, it too is below its moving averages. It started the year or ended last year below the 50-day, which was a signal to be out, and now it's trying to hold this spot. I don't know if it stays above this, but this will probably be something I look to see if it continues to hold here. You have defined resistance into this channel now. And then here would be if it comes in below. So for Facebook, it's already probably below this pivot, which is 101.67. And then you have Monday's low, 99.75. So the way you'll see relative weakness is what trades below Monday's low first, and does anything not trade below it. And if it doesn't trade below it and we find support and rally, that's probably the names that go up first. That's relative strength. If your name is below the Monday low first and things still feel heavy, don't be buying it there, because chances are that's going to help lead us lower also. So make sure you have a few of these things in the back of your head. As far as second, third, fourth tier names in down moves like this, I think you should just stay away. Look at ETFs, look at leaders, look at oil, look at things that have liquidity. I know the solar names have been a little stronger, maybe. I guess you could look at FSLR. It did close really strong. It's down $2 or so. I guess see if it could hold this gap. If it could hold this gap, maybe it holds in there. It's hard to believe that this thing is so strong, but it has been. Let's look at Solar City real quickly. Solar City, red day. So not every one of these solar names are created equal. But I would just be careful. These air type groups. Once the air comes out, the air comes out also. You saw that and also be careful with some of these January effect type plays. I know some guys got caught in FIT. FIT looked really good right here, right, for the day. On Monday when the market was weak, okay, it reversed. It had some volume, okay, and looked good, and then opened up and then got absolutely annihilated. So if you were in this thing, hopefully you use my rules saying if it opens up above the momentum level and goes red, you get out, and you definitely get out if it takes out the prior day's low. That right there, without this whole thing, would have been an outside day. So I don't think anyone was hurt or in the way, but it's just a good rule to go by, especially considering it broke all this. So lots of danger out there, danger that could wipe you out, and it's way too early in the year to be wiped out. Also areas to make money. I know that a lot of guys, including Luke and Harry, whoever it is, I'm not going to call you guys out on the virtual trade floor, have been sitting short since the last day of the year. I wish I was able to do that a little bit better than just writing about it in my note and my thesis. Hopefully that changes moving forward. But if you're one of those guys that had a great 6-year run because you've been buying dips, playing breakouts, adjusting your portfolio approach or your tactical approach or this or that, that's fine. Maybe even look into that further, because this year could be one of those years where things are a lot heavier than stronger, and you might want to be a lot more careful where you look to buy those extremes and not get lulled to sleep and then get run over. And with all that said, we'll see what happens today. We're down 35 handles or so. We're below Monday's low. We have Fed minutes at 2 o'clock. You have the jobs on Friday. The oscillator is probably going to be like minus 45, minus 50 to open, so it's going to be oversold. Just the question is, how does it transpire? And I've helped, and I think a lot of guys are risk down, and even if you're in the little longs, it definitely, little cuts, could add up versus sitting short and high-fiving like some of you are out there as well. And sorry for babbling, it's been a long 3 days, not a long, actually bearish, but you know what I'm saying, a tricky environment to say the least, considering first 5 days typically new flows come in, and if the sellers can overpower any new flows and in the seasonality couldn't hold up 2015, it's another little signal to just take care and don't put yourself in harm's way and keep to your system and make sure you have stops and be prepared each day, and I'll hopefully help you do that. Have a great day trading. See you at the recap.